Good evening, everyone. I'm October Batch. So, I want to, what I'm teaching you guys is my trading strategy, which is basically market structure, liquidity, point of interest, then the entry and exit of it. Now, the topic will be split into four sections: the market structure for the first topic, then the liquidity, and then one point of interest for the first session, that is for today's session. The second session will take the two point of interest I make use of, which is the order block and then the breaker block. Then I will give you guys the four rules I follow while picking a point of interest to make it valid. Then the third class, the third session, be about types of liquidity and how to take profits using liquidity. Then the fourth class will just summarize everything. So the topic is market structure, market structure, liquidity, and then points of interest. This is the topic: market structure, liquidity, and point of interest. This is my trading strategy. So I will take the market structure first, then liquidity, then point of interest. So, what is market structure? So, market structure is the behavior, condition, and the current flow of the market. It's basically the current order flow of the market. So, market structure is the behavior, condition, and current flow of the market. This is what market structure is: the behavior, the condition, and the current flow of the market. That's the basic order flow of the market. That's what market structure is: the pattern in which market moves from one direction to the other. So if prices will move from, let's say prices are 20 and is moving to 30, the pattern and the condition in which market moves from that point to the next point is what market structure is. Simple as that. Then there are three types of market movements. There are two types of market movements. There's the trending market, and then there's the ranging market. So there are two types of market movements. So market structure is the behavior, the condition, and the current flow of the market. It's basically the current order flow of the market. And there are two types of market movements. There's a trending market and then there's a ranging market. The ranging market, there are two types, which is the uptrend and then the downtrend. So So types of trending markets, there's the uptrend and then the downtrend. So what I mean by an uptrend is when market is making a series of higher highs and higher lows. That's what it means for market to be on an uptrend. So market is making a series of higher highs and higher lows. For this scenario is market making a series of higher highs and then higher lows, higher highs and then higher lows, higher highs and then higher lows. This is what it means for market to be on an uptrend. Meanwhile, a downtrend is market making a series of lower highs and then lower lows, lower highs, lower lows, lower highs and then lower lows. So it means for market to be on a downtrend. So this is an uptrend right here, and this is a downtrend. So for uptrend is when market is making a series of higher highs and then higher lows. For downtrend is when market is making a series of lower highs and then lower lows. Then we have the ranging market, which isn't really trending anywhere. It's just moving from one particular point to another. If you move from point A to point B, you move back from point B to point A, move from point A back to point B. So it's ranging. A range means like being stagnant. There's really no much, just being in the same fixed position from here to here, and from here back to here, from here to here back to here to here, from here back to here. This way it means for market to be on a range. It's more of a consolidation. So ranging market. So so the market structure is the current flow of the market, behavior and the condition of the market. There are two types of market movements. We have the trending market and we have the ranging market. In the trending market, that's when we now have the uptrend and then your downtrend. And then we now have the ranging market. So this is just introduction to market structure. Now, what I actually look out for in trading market structure part of this strategy, there are two things I look out for. I look out for market structure shifts. Number one, I look out for break of structure. Number two. Now, what is a market structure shift? Now, market structure shifts, the two things I look out for while picking the structure part of the strategy is market structure shifts and then break of structure. Market structure shift, this is an indication that a current trend is about to end and the new one is about to begin in the opposite direction. So it's an indication the current trend calling my mobile. So a market structure shift is an indication that the current trend is about to end and a new one is about to begin in the opposite direction. So that is what market structure shift is. So type it out. That is what market structure shift is. It means it's an indication that a current trend is about to end and a new one is about to begin in the opposite direction. Now, what do I mean by this? This works, market structure shift works majorly for trending markets. So let me give you an indication of a market structure shift. So let's say, for example, that price was on an uptrend, previously on an uptrend. That's you seen market making a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows, higher highs. The market does something like this. Instead of making another higher low to continue the uptrend, market does something like this. Now, if you're not paying attention, the market structure has shifted. That's why it's called market structure shift. The previous trend that market was on before would not be maintained. Now, it's an indication now that this is no longer an uptrend, but we're now looking for market is now turning into a downtrend. So if you are taking buys previously and you witness a market structure shift, what you should be looking out for is now sells. So this shift right here is an indication that the current uptrend is about to end and the new trend, which is downtrend, is about to begin. So that's why I said it's an indication that the current trend is about to change and the new one is about to begin in the opposite direction. Could you see my screen? Can you guys see my screen? Can you see my screen? Okay, no problem. So let me go. That's what I'm saying. So the market structure shift basically is an indication that the current trend is about to end and the new one is about to begin in the opposite direction. So previously, market was on an uptrend. You can see the characteristics of an uptrend is higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. So this is the higher high, then this is the higher low. This is the higher high, this is the higher low. This is the higher high, this is the higher low. This is the higher high. Then what the market do? It broke down this low. Meaning that this is no longer an uptrend. It has already changed structure to the downside. So you mark this place out as your market structure shift. That is what this is. So mark it out with MSS. That is what market structure shift stands for. MSS. So let me give a proper indication using the charts. Paying attention to this trade right here. You can see market making a series of higher highs and higher lows. Higher highs, higher lows. Higher highs, higher lows. Higher highs, higher lows. Higher highs, higher lows. Higher highs. Then market did what? Made a lower low right here. So pay attention. Previously, I will be taking buys from this trade. Higher highs, higher lows, higher highs. So we're taking buy continuations. But what did the market do? This was the last low in the market. But this particular move that happened here now turned market. Can you guys see my screen? Can you guys see my screen? I don't know what's wrong with network. Hope you guys can see my screen and hear me. Know what's wrong with network. Okay. So higher highs, higher lows, 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 higher highs. The market now broke down the last low and made a lower low. This here is an indication that market is now turning bearish. Market structure shift happened right here, but this was the last low. And the market took out that last low. Now changing the trend of this market from an uptrend to downtrend. So this is where the market structure shifts is same as what I marked out here. Market on an uptrend, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and then broke the last low and the lower. This has already turned market from a previous uptrend to a downtrend. That is market structure shift. Same as the market being on a downtrend and turning bullish. So sorry. So let's assume this was an so this lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows. Then some market does something like this, lower highs, lower lows, then does something like this, higher high. This was a previous downtrend because the characteristics of a downtrend is lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs and low. Then market was supposed to make another lower high here to continue the downtrend, but instead it made a higher high, meaning that this market is no longer on a downtrend. It's now changing direction to the upside because there was a market structure shift. So this was where the market structure shift for this particular trade is. So I will indicate that with MSS. Now, for people that ask about time frames, there is no particular time frame for any strategy. Structure is structure. Market structure is market structure. The only thing is that it's good to trade with the confluence of the higher time frame. If you are looking for buys, at least your higher time frame should be in a zone where buys should happen. But structure is structure. Structure on 45 minutes is the same structure on 30 minutes. Let's go, for example, there was a market structure shift on 30 minutes. If I go to 45 minutes, it's still a market structure shift. If I go to 5 minutes, it's still a market structure shift. Structure. Structure is structure. Just that, see, still an uptrend that can bearish. 10 minutes, the same thing. 15 minutes, the same thing. You just have to identify structure. Structure is structure, regardless of time frames. You understand? So that was market structure shift for the upside, and then for a bullish market that turned bearish, and also for a bearish market that turned bullish. So a market structure shift is, that is one thing I look out for the market structure part of the strategy. The second thing I look out for is a break of structure. Now, what do I mean by a break of structure? A break of structure is when market breaks a significant zone in price while still remaining in the same direction it was at before. While still remaining on the same direction it was on before. So in market structure shifts, it will change trend to the opposite direction. But in break of structure, it will break a significant zone in the market, be it a high, be it a support zone, be it a resistance zone. It will break a particular zone in the market, but it's still going to remain in the same trend that it was on before. So let me write it down. Who's the person drawing that thing on the screen? So break of structure is when market breaks a key level in price while still being on its current trend. Now, this key level can either be a support zone or a resistance zone. That is what key level is. So let me give you a clearer example of what a break of structure is. Let's say this let me say this is a resistance level in market. This is a resistance zone market. This is a resistance zone. So I'll mark that with resistance. So, and then price happened to be on an uptrend, which is market making a series of higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. Then something like this will happen. What is wrong with my internet? Something like this will happen. So I'm sorry, people keep interrupting me in the group. I don't know what's wrong with some people. If you know someone is teaching, instead of you to wait for the person to finish teaching, will I be teaching and be checking test messages? They will keep sending tests, and some people are even calling me on my direct mobile, interrupting my network when I'm teaching. So for market structure shifts, there's indication that price is about to change direction to the opposite side. But in break of structure, a key level is broken in the market. And market is still going to remain in the same trend it was on before. So for this particular trade, it was on an uptrend, and you can see higher highs and higher lows, higher highs and higher lows, higher highs and higher lows. The market now made a higher high, but the higher high that it made broke this resistance level. This is what a break of structure is. If it was to be a market structure shift, market would not break to the upside, it will simply just break down, changing direction to the downside. But in break of structure, it will still break towards the direction that market was trending at before. That is the difference between market structure shift and then break of structure. In market structure shift, it changes direction to the opposite side. In break of structure, it still maintains its current direction, but it breaks a key level in the market. So this is the break of structure for an upside, and then this one should be a break of structure for the downside. So So this is the break of structure for market being on an uptrend. Then this should be the one for market being on a downtrend. So let's assume that this is a support zone. This is a support zone, and market was on a downtrend. That is lower highs and lower lows, lower highs and lower lows, lower highs and lower lows, lower highs. And the market does something like this, breaking the support zone. Market was previously on a downtrend, and then the zone that it broke was still on a downtrend. So it's still continuing the current trend it was on before. If this was to be a market structure shift, so market should actually break structure and then change direction to the upside. That is the difference between a break of structure and the market structure shift. Pay attention. This is a market structure shift. Previously on an uptrend, change direction to the downside. Previously on a downtrend, change direction to the upside. But for break of structure, previously on an uptrend, still broke structure on the upside. Previously on a downtrend, still broke structure to the downside. That is the difference between break of structure and then market structure shift. These are the two things I pay attention to when I look out for my structure part of my strategy. Once I open my charts and I see, I know I trade market structure, liquidity, and point of interest, and I open up my market structure part of my strategy, what is the first things I look out for? I look out for the current trend, and I look out for my break of structure or my market structure shift. Those are the only two things I look out for. So I gave a graphical example of the market structure shift here. Let me also find an example of a market structure shift. Sorry, of a break of structure. I gave an example for a market structure shift. Let me also find an example of a break of structure. So this trade, this is a resistance level in the market. And clearly see this was a resistance level in the market, right? And then market was making higher highs and then higher lows, which you can clearly see from this. You see higher highs, higher lows. Here, okay, no, let me just use this: higher highs and higher lows, higher highs and higher lows, higher highs, higher lows. Then what did it do? It broke past this key level, being a resistance zone, but it still broke past it while we're still maintaining the uptrend that it was on before. So this is the difference between a break of structure and the market structure shift. If it was to be a market structure shift, this was what will happen. Market will change direction to the downside. But since it was a break of structure, the market changed direction to the upside. So it was maintaining its current trend while still breaking a key level in the market. That is the difference between a market structure shift and a break of structure. So that is the structure part of the strategy. Now it's time to move on to the liquidity part of the strategy. So this is the structure part of the strategy. It's time to move on to the liquidity part of the strategy. So liquidity. So what I use as my liquidity for taking my entries is inducement. That's what I use as my liquidity. Now what is an inducement? An inducement is the first valid pullback that market makes after a break of structure or a market structure shift. Liquidity is the first valid pullback that market makes after a break of structure or a market structure shift. So now, when you open up your charts and you've gotten your market structure shift or your break of structure, the next thing you should look out for is your liquidity, because that's why the strategy is lined up like that. Market structure, liquidity, point of interest. It means once you open up your chart, first thing you should look out for is the market structure part. Once you've gotten either your break of structure or your market structure shift, next thing you should look out for is liquidity. It's piece by piece. So once you've gotten your market structure, you go for liquidity. Now, what is my liquidity? It is my inducement. And inducement is the first valid pullback that price makes after a break of structure or a market structure shift. So after you've gotten a break of structure or a market structure shift, the first valid pullback that market makes. So liquidity slash inducement. So that's my liquidity is my inducement. So inducement is the first That is what my inducement is. The first valid pullback market makes. Sorry, market makes. Inducement is the first valid pullback market makes after a break of structure or a market structure shift. So let me give you a visual example. So let me use the market structure shift on first. So for the uptrend, this is an uptrend, and the market made a market structure shift. So before you can take any inducement, before you can confirm your inducement, you have to first see either a break of structure or a market structure shift. Pay attention. So this was a market structure shift right here. After that, markets should make some kind of pullback close to the zone that market broke upon. So let's say this is your pullback. The market will continue going in that direction that it broke structure to. So market broke structure to the downside. After breaking structure to the downside, it will make a pullback. This pullback that market makes close to the zone it broke structure from is your inducement. That is what my liquidity is. So this is the inducement for this case. This is the inducement for this case. Same as for this, if market actually breaks structure to the upside, after breaking structure, it will make a pullback. That's this. Then before eventually going back up. So this pullback is what your inducement is. Now know something. Your inducement is a trap. It is not your entry. Inducement is a trap in the market. Eventually, it's inducing early traders think that market is about to change direction, but meanwhile, market will still come out and take out that inducement. That inducement has to be taken out. That is what it means for market to move. Liquidity has to be taken out from one point, and if liquidity is taken out from this point, it's targeting the liquidity on the other point of the market. That is what fuels the market liquidity. So this is the inducement, the first pullback that market makes after a market structure shifts or a break of structure. So this is the market structure shift for this side, and this is inducement here. And this is the inducement right here. So it said the inducement is the first valid pullback that market makes after a break of structure or a market structure shift. So this is the market structure shift part. This was when market broke structure to the downside. This is the first pullback it makes before continuing that move. Same as this, market broke structure to the upside or changed structure to the upside. After it changed structure to the upside, it made the pullback before continuing that move. The pullbacks it makes is the inducement. So let me show from a live chat. So this was the previous move in the market. Pay attention to the previous move. So as market was on an uptrend, you see market being on an uptrend, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Then this was when market shifted structure to the downside, right here. This. After market shifted to the downside, there was this pullback that market made close to entry. That's this pullback. This particular pullback is what my inducement is. You could use this, but the first pullback that market makes before pushing market down that zone that it broke structure to or shifted structure to. For example, so market shifted structure to the downside here. So where the market structure shift is. After that, market pulled back up to this level. So this was the market structure shift. This was the pullback that market did before continuing the new structure shift that market did. So after market shifted structure to the downside, it pulled back up here before continuing the move. Understand? So this pullback is your inducement. That is your liquidity. Pay attention to when market comes here. Markets will come here, bounce back down, come here, bounce back. So most people will be selling from this zone, thinking that this is where market is supposed to be reversing. It may work for you once or one time, two times, but the overall TP for market to take out the liquidity is not going to happen until that first liquidity on this side has been taken out. So this is where the inducement is for this particular trade, because that is the first valid pullback that market made after this market structure shift. So it's just like this. Market was on an uptrend, shifted straight to the downside, made this pullback. That pullback is your inducement. Same as this. This pullback is your inducement. So same as market being a breaking structure. If there was a structure shift in the market, for example, this was a break of structure. After that, market will make a pullback. After making the pullback, it will now push up again to that direction. That pullback it makes is your inducement. So inducement. This is your inducement here. Pullback. Same as market breaks the support zone down here. So market will make a pullback. This pullback for continuing this move, this pullback that market makes for continuing that move is what your inducement is. Now, the pullback can be multiple candles and it can also be one candle. Everything depends on the time frame because 10 5 minutes candles, let's say there are 5 minutes candles and it's 10, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. On 1 hour time frame, it can just be a single candle. On 10 minutes, on the 5 minutes time frame, it can be 10 candles. On 1 hour time frame, it can be a single candle on 10. So the how many candles it is does not really matter. On this gold, there are multiple candles. You can see one here, but if you change time frames, it's only one candle. So it does not matter whether it's a one candle pullback or multiple candle pullbacks, as long as it's a valid pullback. And what I mean by a valid pullback is this. What I mean by a valid pullback. Well, if market breaks structure to the downside or to the upside, let's say this was resistance zone, and then market does something like this and breaks past it. Market breaks past it like this. After breaking past it, it makes this pullback. What I mean by it being valid is that's to push market up close to at least 50% of where this last move stopped. From here to here, at least 50% of the last move, where it will come back down to clear that inducement and trigger the main point of interest. It can as well be this breaking out or shifting structure, pulling back. This is your first pullback. Can at least pull market to the same equal high, then come out and take out the inducement before going up. It can also be market breaking out, making the first pullback. The next move will push it higher before it will eventually come down, clear that inducement, trigger the main point of interest, and start moving up. This is what a valid pullback is. A valid pullback has to at least push market close to 50% of the last move that happened. If this is your resistance level, and market breaks out here and then makes this as a pullback and then pushes market up a bit and then starts coming to trigger the point of interest, this is not a valid pullback. This can just turn market bearish. This can just be a liquidity sweep. The first pullback should at least push market up close to like 50% of the last move that happened before coming to trigger the main point of interest to hold the breakout or the market shift. That's what I mean by a valid pullback. So this is the one for gold market structure shift. This is the first pullback right here, and then I will show for JPY chart that I was on for a pullback in break of structure. So market was previously on an so this was a resistance zone in the market right here, and the market was making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and broke this resistance level while still maintaining that same current trend it was on before. So I'm not going to be looking for sales on this trade. What I'm looking out for is buy, because it broke a key level in the market and at the same time it maintained its current trend. So in break of structure, I'm still going to be looking for buys on this trade. So as market have already broken structure to the upside, I've identified my break of structure on this trade. Next, now I'll be looking out for my first valid pullback, which is my inducement, which is right here. This is your inducements. Like I said, it can be a single candle, multiple candles. But pay attention, you can see this candle right here, this candle. And after this candle, this pullback happened, still pushed markets up more than the last move. So this is a valid pullback. So I've gotten my break of structure. Yeah. I've gotten my inducement right here. Same thing as this gold. I've gotten my gold. I've gotten my so for gold. I've gotten my market structure sheet right here I'm getting my inducement right here. So like I said, the inducement is the first valid pullback that market makes after a shift in market structure or a break of structure. That is what your inducement is. That is what I use as my liquidity. Do you understand? So first of all, if you open your charts, first thing you should look out for is the market structure part of my strategy. Am I seeing a break of structure or am I seeing a market structure shift? After you've gotten your market structure shift, just like I did here, or your break of structure, just like I did in GG, next thing you should do is now look out for the very first valid pullback that market makes, which is your inducement. After you've gotten that your inducement, you now know that the only thing remaining in that particular trade is for you to get your point of interest. Now, I make use of 2 points of interest. I make use of my other blocks and I make use of my breaker block. I'm just going to take the other block in this section. The next session, I will now introduce the breaker block. And knowing when to use your breaker block or knowing when to use an other block, that is what I'm going to introduce in this class. There are 4 rules in picking a point of interest. There are 4. Those 4 rules will now tell you when to make use of a breaker block and when to make use of an other block. But for this particular class, I'm going to teach the other block for the first session. So if you open up your charts and you see your market structure shift or you see your break of structure, next thing you should look out for is your inducement, which is your liquidity. After you've gotten your inducement and your liquidity, you've already fulfilled 2 parts of the strategy, which is market structure, then liquidity. What's the third one? Your point of interest. Now, like I said, I make use of my other blocks and then my breaker blocks. For this class, I'm taking just the other block. So now that you've gotten your market structure shift in this particular trade, you've gotten your inducement in this particular trade, next thing to look out for is your point of interest. So, other block. Now, another block is a zone in the market where there are a lot of institutional orders. Now, do you understand that you that trade or us that trade with $1,000, $100, $10,000, $100,000, we don't really move the market. Nothing. We're not the market makers. There are institutional traders that trade with over billions of dollars. Those are the people that actually moves the market. That is where those places that they place their orders. That is what another block is called. So there are literally 2 types of order blocks. There's the bullish order block, and then there's the bearish order block. Now, for your bullish order block is when you're looking for buys, and then your bearish order block is for when you're looking for sells. So, for point of interest, so order blocks, there's the bullish order block and then there's the bearish order block. How do you identify a bullish order block? A bullish order block, you will see a bearish candle and then you will see a bullish candle engulf it. So something like this. This is what a bullish order block looks like when you're looking for buys. So this is what a bullish order block looks like. You see a bearish candle, you see a bullish one engulf it. So let me make it look this thing more like the ones you would see on your chart. So this is the bullish order block. If your chart is red and blue, you see. So you see if your chart is red and green, you see something like this. So it doesn't really matter. So this is a bullish order block, and then a bearish order block is you will see a bullish candle, then you will see a bearish one engulf it. So this is the bullish candle, for example, and then you see another candle bearish engulf it. So that is what a bearish order block looks like. So this is what a bearish order block looks like. A bearish one. So a bullish order block, a bearish order block. So this will look something like this. So this is a bullish order block right here. And this is a bearish order block right here. So use this bullish order block when you're looking for buys. You use this bearish order block when you're looking for sells. Now, I know people will also ask, how do you pick other blocks? Pick other blocks by picking the demarcation, the difference in the two, the demarcation. So this was the bearish move. This was the bullish move that engulfed it. So you pick your entry from here. Same as this was the bullish move, and this was the bearish move that engulfed it. You pick the difference from here. Now, most people will also ask, because I already know what's in your mind, what if there are wicks in the other block? How do you pick another block if there are wicks in the other block? So, for example, let's say this was a bearish order block, and then this is the wick, and then this is how the candle is. This is the wick, this is the candle, and this is the wick. Now, the rule in picking wicks in other blocks is if the wick of the other block is bigger and longer, and is longer than the body of the other block, you pick your entry from the body. You understand? So if the wick of the other block is longer than the body, you pick your entry from the body. Or in a situation where the wick is smaller than the body, for example, this is the body, and then this is the wick. So this is the body of the other block. So it's bigger than the wick of the other block. If you're picking your entry, pick your entry from the wick of the other block. Do you understand? Because in this case, the body of the other block is bigger than the wick of the other block. Pick your entry from the body from the wick of the other block. But in a situation where the body is smaller and the wick is longer, pick your entry from the body. Do you understand? So in this situation, if the wick is longer and the body is smaller, pick your entry from the body. Or if the wick is smaller and the body is bigger, pick your entry from the wick. That's just it. So this is a bullish order block, and then this is a bearish order block. So for this trade, for this scenario, for this one I'm using as this scenario now, we have gotten our market structure shift right here, gotten our first valid pullback, that is the inducement right here. The next thing to look out for, now pay attention, I said my inducement is my liquidity. So I've gotten my market structure part of my strategy. I've gotten the inducement part of the strategy. It's time to now look out for the breaker block part of the strategy. Do you understand? So I've gotten my market structure, which is my market structure shift. I've gotten my liquidity, which is my inducement. Since I'm looking out for sales, what I'm going to now be looking out for is my point of interest. That is my order block. And in this case, I'm looking for sales. It means I'll be looking out for bearish order block. So how does a bearish order block look like? You see a bullish candle, and then you see a bearish candle engulf it. In this case, this is what the bearish order block looks like. You see a bullish candle, then you see a bearish candle engulf it. So I marked my order block from this. And what the market do? The market eventually tapped into this order block, continue selling. So let me see if I can find before. That's when I made this analysis. See if I can find it. So this was the trade. Can you see? I saw my market structure shift, I saw my inducement, and I marked on my order block. This was before NFP. So even people that gamble news, you don't have to. This trade was during NFP. It triggered before NFP. Technical analysis can actually tell you the direction of the news. If you're correct with your technicals, trust me, news mostly confluences technical analysis, except few cases it does not. So I had this analysis before NFP. So this market triggered during NFP. Pay attention, during NFP. That was when I took this trade. But this move happened during NFP. This is it 130. You can see. Okay. Yeah, during NFP. But the whole candlestick happened during NFP news. So this is it for the market structure shifts. Let me also look for the breaks for the bullish scenario. So let me also look for the bullish scenario. In this case, I identified my break of structure. I identified my first pullback, which is the inducement right here. And then, because this was when market broke structure to the upside, after that, the first valid pullback the market made was this. After market made this first valid pullback, market now started coming back to trigger my entry. Now, I used my breaker block, but in this case, let me just use other block because it's only the other block that I've taught you guys. So this was the other block right here. So I will wait for price to now come in and trigger that other block. And after market trigger that other block, it's continue buying. This was also during NFP news. So as long as you are right with your technical analysis, fundamentals actually confluences your technical analysis. If you are right, if you are correct. So this was the move. So market structure, liquidity, and then point of interest.